So thank you everyone for joining us today, especially on a Saturday morning. So this is our investing in inflation. That's the title of our fourth quarter strategy. In a nutshell, what we see is inflation pressures popping up almost everywhere, and that's why. And as a result, our team is basically how we're going to invest in this current inflationary environment. Okay, so let us move on. This is our typical disclaimer page. I know most won't read it, but let me just summarize it for you. That what we are saying, these are our views and opinions. We take a lot of information from public sources, like Bloomberg, CIC, even from the authorities, and presume the data is to be accurate. And again, the very last paragraph, do seek advice from your financial advisor, because our recommendations here do not uh, customize to your various investment needs. Okay, thanks for bearing with me on that. Okay, we'll just have two slides later on, just on how did the STI perform in the third quarter. So in the third quarter, if you can see from this bar, we are using US dollar returns. I think in Sing dollar, for the third quarter, STI was down perhaps about 1+%. But for us, I think what we are looking at is the US dollar. So you can see from the table here, what did well. This is really the year of the commodities, because commodities was the best performer. You can see from here, it's up 7%, and for the whole year, commodities was up almost 41%. So this is really the year of the commodities. For the STI, in US dollar terms, we were up about 5%. Again, US is still the big outperformer. And we're beginning to see bonds starting to lose traction. And among the various major asset classes, the weakness here is from gold. For the third quarter, sorry to jump around here, but for the third quarter, you can see that the MSCI Asia ex Japan, which is essentially all the stocks in China, in very layman terms, all the stocks in China, ASEAN, and as we know of the sell-off in the Chinese tech names. So as a result, and the MSCI or Asia, the Asian Pacific stocks were the weakest, with the decline in 9% for the third quarter. So again, it was another soft quarter for us in Singapore. If we go into the Straits Times Index, the STI, there are 30 names inside the STI. Only 1/3 made any gains, and most of the gains were pretty small. So the remaining 2/3 of the STI, or you can say like 2/3 of the market, was in the red, in a very general sense. So if you can see from the left, we always start with the banks, because the banks account for almost 40% of the index. The OCBC was the worst performer, and the best continues to be DBS. What did well? That means what made you money from the STI, at least for the third quarter, were some restructuring names. I think like Capital Land, formerly known Capital Land, now it's called Capital Land Investment. That was up almost 15%. The other one that did well was Singtel, because of all the recent restructuring, and also a rebound. More importantly, was a recovery in their Australian operations, and even Singapore started to see some improvement. And more importantly is the India turnaround. There was some regulatory changes that they deferred some of the licenses, the multi-billion license that was supposed to be paid. That was also deferred, and also competition is starting to improve, and prices started to creep up again. In terms of the REITs, it was kind of flattish performance. The stocks that really pulled down the STI, the worst performers, I guess, were mainly the Jardine names. Although the results like Dairy Farm, for those who do not know, Dairy Farm is like your Guardian, your Giant in Singapore. So what happened, we believe, is that when COVID spread into Indonesia in the third quarter, into Southeast Asia, Malaysia, and when the cases started to pick up, that's where you had this share price pressure on the Jardine names. Although results-wise, it was actually very strong. But everyone was worried about a slowdown, and as a result of this, you can see the Jardine companies were the one that pulled the index the most. Consumers were also weak. Likewise, property was surprisingly weak. But we are very positive on CDL, which I think Natalie later on will elaborate further. Okay, I think that's it. We try not to dwell too much on the past. So in terms of our next few slides, I'll just run through what is the macro situation. Now, we're not going to forecast, but just to give everyone here a sense of what's happening in the global economy, what's happening in the Singapore economy, before we move on to some of the macro trends that we see. Okay, in terms of the global economy, we're just going to go through the various key countries. So if you look at the US, from this chart, we are using very simple to understand metrics here, macro data, so that everyone can kind of intuitively understand. So if you look from here, the US consumer has been very strong. If you look at the growth rates, US used to grow the retail sales. That means people buying and shopping. You could say it's probably trending about 5%. But you can see this. We had a collapse here because of the recent technical recession, I guess, due to COVID. But you can see that since then, retail sales has bounced. Although you can see this is a base effect, but you can see that now retail sales is trending about 10%. It's far higher than even the pre-pandemic levels. And more importantly, if you look at the absolute amount, so you can see that the US retail is on a 12-month basis. It is not just the base effect that because last year was down, then you get this big bounce, but it's because you can see this shaded here that it's a bit hard to see, sorry, but the beige color, you can see there's a big jump. So US retail sales used to be around 5 trillion. So you can see that there's a huge jump now to above to 5.5 trillion US dollars, where it was used to be trending here. So there's a big jump. It's not purely because of the bounce from the lows here, but there's a big gap up in the retail spending, which has kind of helped the global economies in terms of imports and so forth. And one of the reasons is, of course, the fiscal spending that has come out from the US. So number one, the US consumers are very healthy. Jobs is also very healthy. Why we say that is that although the payroll number, I think yesterday came out, the number of jobs was weaker than expected, but you can see the amount of vacancies out there. The vacancies are actually at all-time high. So if you just look at the openings, sorry, not vacancies, that means the amount of jobs available is the highest on record. So what in a way, is like almost, data-wise, for every one job that's being filled, there's like 10 out there that's not filled. So there's a lot of jobs out there, and for us, it's a sign that the economy is strong, but just that employers can't really find the workers right now. If you want to know, because the US retailers are spending so much money, like who is the beneficiary? So actually, from us here out of Southeast Asia, I think we should say thank you, because we are the ones that's benefiting. Like countries like Vietnam, Malaysia. If you look at the deficit spending over the last 3 years, the deficit with US, deficit means the US is buying a lot more goods. Goods from Southeast Asia. For China, it has already peaked and it seems to be moving sideways, even though the US is buying a lot more goods. But you can see that Southeast Asia is a big winner. It used to be, you just pull a number here, maybe like 80 billion, 90 billion, but over the past 3 years, it's doubled to almost 180 billion. So now, like, Southeast Asia is becoming an even more important manufacturing hub. Of course, we can't displace China. China's deficit is almost 300 billion, but we are getting there. We are becoming more and more important as a manufacturing base supplying to the US consumer. And this is, of course, good news, because this is new jobs and new growth for Southeast Asia. Okay, now if we go, that was US. Now we swing to China just to have a look. What is roughly the situation in China? Things are definitely slowing down in China. You can see the manufacturing activity based on the PMI. These are like surveys about how is manufacturing activity in China. And retail sales is also has been weak, although you get a big bounce here, but the retail sales is even slower than in the US. And of course, if you just a quick snippet, if you remember, China retail sales, China was I guess the consumer that everybody wanted to target. It was like so-called the golden goose, because you can see the China retail sales was up almost 20% for many years, but recently it has slowed down to even probably 7-8%, even slower than what's happening in the US. So there is a slowdown in the US. If you quickly look at this is my last slide. If you quickly look at Europe, Europe is actually doing pretty well. if you just look at the unemployment numbers, of course there are many more data points, but we are just using something that's easier for everyone to understand. If you can recall, let's look at the red line here. This is the Italian unemployment rates. So there are two things to note here. In 2013, when we had all this news about Greece, the so-called sovereign debt crisis, you can see that the unemployment rate in Italy spiked up to the highs, around 12%. And this is important because when they joined the EU, if you're an Italian, you'll be asking, why would I want to join the EU? You can see that since the joining EU, our unemployment rates was even higher than before joining. But right now, thankfully, things are coming down. And it was actually hitting the around these levels, but of course, because of COVID, it bounced back up. But importantly, it's trending down. And I guess from here, we can see that the one that's benefiting the most from joining EU could probably be Germany, since when they joined the EU, the unemployment rate was 8%. Right now, it's dropped to the lows of 3%, which is now virtually full employment. But for us, most important is that the trend line is coming down, and Europe is also healing. I'm just using one data point, of course. Okay, that's just to give you a sense of what's happening globally. I'll move on to the Singapore economy. I guess that's more important. I think the first question we wanted to know is that, is the Singapore economy now higher than the pre-pandemic levels? There's of course obviously a big bounce here, but right now we are still below pre-pandemic. So compared to, so we are like around 4% if you want to do a measurement here, it's around 4% before pre-pandemic levels. So although we recovered, but we are still way below. We are still slightly off. Now, hopefully, when the third quarter GDP comes back in, it will show that we are climb above, and that's a good sign. It just shows that the economy has recovered from what has happened pre-pandemic. Okay, what has been helping the economy has been exports. So thankfully, even though our borders were shut, we're all stuck here, we can't travel, people can't come in. But the good thing is that our goods can go out and can come in. So the electronic exports and in general, all the exports may continue to resume. So we still managed to continue to do trading with other nations and so forth. And that was helpful. As you can see, exports continue to climb and continue to accelerate. So that is one of the most positive parts of the economy for Singapore. The other thing was also the amount of liquidity. Let me explain this chart. I know there's a lot of numbers here, but let me just explain. So this is the amount of reserves that Singapore has, foreign reserves. So we used to, pre-pandemic, you could say we were around 300 billion, but you can see from the blue line, we hit almost 400 billion. There's a huge amount of liquidity that came in, and it only came in when the pandemic hit. So if you look at the amount of inflows, until 2018, we were up 8 billion in terms of the reserves. 2019, it dropped back down to 8, so net, nothing happened. Then 2020, when the pandemic hit, it seems to suggest that we kind of reinforce our safe haven status. A lot of liquidity came in. There could be other reasons too, but a lot of liquidity came in, and you can see that year to date, we could probably hit another 80 billion of inflows. Of course, some of it is trade, but most of it is just pure inflows into capital inflows into the country. Of course, you'll be asking, okay, that's good. So what's so important about this? So I guess the one thing would be, of course, it's positive for the Sing dollar. The other positive is, of course, in a way, it could be even positive for wealth management and property here, because there's more money coming in here, and apart from parking into bonds, they obviously have to park the money somewhere. Hopefully into property, or even they will park it into more wealth management products. So these are just anecdotally, this could be a indicator of the foreigners coming in and helping the liquidity and domestic situation here. Okay, so those are the positive parts of the Singapore economy. In terms of the negative parts, we all know, I think the border closures has been the big issue now. Just as a data point, we used to have like 19 million visitors. Now we are probably less than, I can't count the numbers, it's probably like 10%. So sorry, 1% of people, so we are down 99%. So there's only like 200,000. Initially, we thought 2020 would be a record year of visitors. So this has a big impact to the economy. I think we all know it impacts telcos, impacts hotels, hospitals, and many other retailers and so forth. So this is the missing gap in our economy right now, as you can see from the 99% drop in tourist arrivals. The other one that has been weak for us has been construction workers. I wouldn't say activity. I think activity is recovered, but the shortage of workers has an impact on the economy. So pre-pandemic, we had like 460,000 workers. Right now, we dropped to 400. And this is a big gap to fill. I mean, even during the good days, it probably took us, we probably absorbed maybe 10,000 over 2 years. So now we got 60,000 gap to fill. And this will slow down a lot of BTOs, delay a lot of projects. And there is obviously there is an impact to the economy. Of course, the other side of it is that it's going to be positive for property prices because there's going to be a lack of supply. But this is a hard gap to fill, and it's the one that is going to raise a lot of construction costs here in Singapore, and of course going to hurt some of the construction companies in terms of margins. So this is the other weak spot that is occurring in our Singapore economy. Again, this is just for reference. Okay, I'm just going to move on to, so that's to just give you a sense of what's happening in the global economy and in Singapore, what are the good parts and what are the weak points.